Good evening, everybody. This is Gary Follett giving a webinar on an extremely important topic. Today's topic will be on absorption of the S&P 500 index and where to look for trades in this absorption process. So first, our disclaimer: substantial risk and loss in trading commodity options, past performance and indicative future results. The opinions of Gary Follett are meant to be for trading, for non-trading advice only, based on the educational purpose of Richard D. Wyckoff. So let's go into this chart a little more closely and see what we can see as far as market behavior. As we can see, the market overall is sideways to higher in its range. Understanding the background and trend of the market is extremely important in understanding where to look for trades. And as we can see, we take the recent action. We see the reactionary low that happened on October 3rd. We can see by this action that there's some buying that came into the market due to the high-end close and the high volume, indication that there were sell stops that were hit down here and the market was bought. How do we know the market was bought? The fact the market closed at the high end of the market. Many times we'll get some type of retest to see if that market really has true demand. We do get that retest. The market ends up going here, and we have a pretty strong reaction to the market. This market has decent volume, and the market again closed on the high end. This indicates the market did not have a supply to overtake this particular low, and we found that the market had buying on the retest of the particular market reactionary low. High and close indicates there was buying, and now we have formed some type of trading range. The key to this market is that we have the market continues to go higher. Increasing volume tells you there's a battle going on because the market closes mid-range. We then reject any downside pressure. The market goes higher, and the market seems to be stabilizing in this area. This stabilization of the market going sideways indicates to a process that we refer to in Wyckoff called absorption. Absorption is simply the process in which the market does not sell off at higher levels, is accepting higher prices in the market. The fact that the market is accepting higher prices in the market, we can look for the pullbacks to try to buy the market. We can buy that through a spring position, a penetration of a low and a close higher than that low. And there are other ways that we do stopping action after a result. In this case, we're going to work on the spring behavior of the market to look for a particular trade. Since the background is buying to the upside, and we're rejecting prices that are lower, and then we absorb price at this level, the market has a penetration of this particular low right here, in a spring of the low, a lower low, a close above this low. This is what we call a spring, a penetration of the low and a close above that area, and we'll label this as a spring. Kind of like a diving board. We bend the diving board down. Market then proceeds to go higher, and then we see the market break back down. We call this a secondary test. The market does not show supply volume, large volume and large range, so the market then makes another test. The test of this market also formed a spring to the market, a penetration of the low and a high-end close. This market is accepting higher prices to the market, again, the absorption prices, and now we have worked higher the last several days. The volume does not have to increase on the rallies because the path of least resistance is up, the trend is up, with no supply of volume that's coming to the market. This seems the market accepting higher prices, and because the market is not going down from areas of the market when the market goes higher. As a side note, if we take the reactionary highs and we connect them, we have a general idea of where the market can trade up to. Tomorrow, the market about 3071, but we have a point figure chart short term of 3100 in the S&P. up to this level right here. Outside the scope of the little YouTube today, but I want to point out that the market had buying interest at lower levels. This is part of the accumulation process by the composite operator. The lack of follow-through to the downside after this bar has a low-end close. Then the market went lower to find buying or demand. The high-end close. The market then works itself up. Then the market then absorbs higher prices, meaning as selling is going on, buyers are present. One of the ways that we look for an edge in Wyckoff to look for a trade would be the spring position here and the spring position here, which allows the market to mark up for the last several days in the markets. We do not have supply, meaning large volume, large range to the downside. So that concludes this little short-term chart of the S&P market, currently on October 28, 2019, on the processes of absorption and where to look for trades in the absorption process. Without supply, in Wyckoff, we look for higher prices. So one final note, my email, if you want to contact me directly, is gfullett@ltg-trading.com. And if you want to write me, you'll get 2 free weeks of my daily Wyckoff newsletter that shows support and resistance and where the edges are of markets. Also, 1 free hour of a one-on-one webinar, you and I, recorded for you on any topics that you like about trading. So with that, I want to thank you for listening to this YouTube, and I wish everybody a good evening. And if any questions, please feel free to contact me. Thank you so much and have a great day.